Wealthies, welcome back. If you're new here, this is All the Wealth, WealthMore's wealth building channel. And I'm Mical Jeanlys-White, your host. And with me today is none other than Matt, our portfolio strategist. And we have so much to unpack. We are past the halfway mark of the year, and so much has happened. When I think back to when we did our first episode anticipating what 2026 would look like, things are way, way different. We got past tariffs,
Not even close.
not even close. Probably the one thing we
But,
did get right is there would be no tariff noise.
well, there even still is, but I mean, yeah, not just that anymore. It's been a bit of a wild ride the first 6 months, and it's only July, so lots more to go.
Lots more to come. It's only July. We have the first 6 months down, and we've had the war in Iran. We think we're getting a peace treaty, then we're not. We think there is an end, and it just seems to go back and forth. We have this sticky inflation that just won't go away. And we have rising debt and a lot of consumer concern. And then we also have the ongoing AI trade. Matt, how are the markets doing?
If you went from just December and you slept for 6 months and woke up in July, you'd be pretty happy. Markets are up. The S&P 500 is up about 10%. Tech stocks have done extremely well. Their Nasdaq's up, I think, just over 20% on the year. Things are going well by all means. If you went back to April or the first quarter of the year, you would have been a little bit worried. We would have seen some headlines about the Iran war. We would have seen, we saw a big drawdown in the markets, but it's all kind of turned around and worked its way higher for, the third year in a row. Really, we had a really good 2024, a really good, strong 2025. And here we are in 2026, another good year so far.
Yeah. But Matt, why is there so much optimism in the market? We've seen gas prices go above $5. The war, it's back and forth. The last headline was whether Iran would end up controlling the Strait of Hormuz. Other players are cutting side deals with them. We still have a lot of question marks on what does the future look like in a world if indeed AI can replace so many jobs. So why is the market so optimistic?
I remember we talked about this last time. We said that, bad news can be good news can be good, and good news can be bad, right? It's based on expectations of where things are going. So the markets have taken the wall of worry that we've had this year of all those things you've mentioned, and it's kind of ignored it all. The Iran war was a big shock, and had oil prices continued to rise, things might not be as rosy as they are today. But we've seen oil prices, come crashing back down to where it was before the war started, right? In the 70s. And like the $70s, not the 1970s. We wish. We're not out of the woods yet, obviously. We've seen some back and forth the last yesterday and this morning. There's been strikes from the US to Iran, and then we've all of a sudden there's a headline this morning that Iran wants to talk again after these strikes. So that's still to be continued on where that's going. But oil prices are pricing in not big complications going forward. So we'll see where that goes. Inflation's a real thing. It's 3.3% in March was the latest reading we saw. Federal Reserve targets to 2% inflation every year. We haven't seen 2% inflation in over 5 years. Something's not going right there. People are really starting to feel the squeeze. That's why the next thing you talked about was consumer debt. People are struggling with these higher prices and higher prices, and they've got to get the money from somewhere to buy basic things or finance their existing debt. AI stocks really buoyed the market so far this year. We've seen huge numbers out of certain sectors within the US markets, chip companies and the big tech companies. And that's really what's helped push this market to new highs. I think there was 24 new highs this year already. And while we're, a couple percent off the top, we're still pretty elevated. So
Yeah.
that's something to be discussed further for sure.
Yeah, this momentum is certainly being driven by the AI, the optimism, the expectation of what AI will do, and frankly, well ahead of us actually seeing the revenues. We are so far
Yeah.
out on revenue expectations for some of these firms, but there is a belief that this is the technology innovation of the century.
But that's the big risk, right? A lot of these companies are being priced to perfection. As soon as they don't hit their targets or they something doesn't go right, they can have a big correction in their pricing. That being said, the earnings have been quite good this year. I think the S&P 500 is on pace for about 24% earnings growth.
Yeah.
That's pretty significant. That's the highest it's been in, decades. So yes, it does look a little bit overpriced in certain areas, and there are going to be certain companies that have run extremely far, but the earnings are looking good so far. But yeah, the price, it's starting to get a little expensive out there, is what I would say. You need everything to go right. And if one thing goes wrong, you can get really, really hurt if you're not properly diversified.
I want to double click here. We talk about diversification all the time. We tell you guys just how important it is. We tell you the S&P is not a diversified index given it's so heavily weighted towards tech and everyone is making the same thesis and expectations around tech. None of the firms have a contrarian approach to it. So you have 6 firms driving so much of the results of the S&P 500, and I wanna remind you guys, it's 500 for a reason, it's 500 stocks in there, but yet 6,
Yeah.
less than 6 of them are driving the vast majority of that performance, so you can just see where that concentration risk sits and why it's so important to have a more diversified investment strategy versus just saying, "I'm going to ride the S&P 500."
Yeah, and what's interesting this year is actually the S&P 500 has sort of underperformed compared to other indices. If you look at international stocks or even small caps, for example,
Yeah.
small caps by small cap I mean, like $1 billion companies. They're not small companies, but the Russell 1000 has outperformed the S&P 500 by about 14%, something like that this year, biggest outperformance since 2001, I think it was. So what we're seeing is a rotation from those
Yeah.
major winners into something else. And if you were just invested in the big six or the magnificent seven, you wouldn't have had a good year this year.
Matt, that highlights the one firm that folks are looking at a little differently within that Mag 7 is Apple, because Apple hasn't gone as long in terms of AI investments. And now people are looking at Apple like maybe they're the darlings. Maybe they're the ones who will get the outsized returns because, hey, everyone has an iPhone.
Yeah, and on iPhones and iPads, their pricing power is way more significant than a lot of these companies. They just announced recently, and you'll probably see this in the inflation numbers too, right? The new MacBooks and iPhones, they've had to increase prices significantly because of the underlying inflation of what they need for their technology. Apple will probably be fine. They have this incredible pricing power among their consumers that they'll just end up buying it anyways, right?
Whole ecosystem that's all interconnected.
Yeah, you're not going to all of a sudden buy a Samsung tablet. It'll cost you more in time than the extra couple $100
You got
to
it.
buy the Apple product.
So speaking of market performance for the wealthies, for those of you who are in our Invest Plus or Premium Advice Plus products and you have money invested in our portfolios, Matt, how we doing?
Yeah, really good. We had a really good year last year. We talked about that a few podcasts ago. It depends what bucket you're in. If you're in the aggressive portfolio, that means, you've got a long-term time frame. You can stomach a little more volatility. That portfolio is up about 22 odd percent to the end of June. But reminder, this is 95% stocks and 5% gold and cash, right? It's not a boring portfolio that you're going to sleep at night if things go the other way. The aggressive portfolio has more technology. It's tied to stocks. So that makes sense that it's done kind of along the lines of the NASDAQ 100 index.
Yeah.
The moderate portfolio, which is the step down, it's up 8.6%. It's got a significant amount of fixed income in there, 30 odd percent fixed income in cash. We got to take a step back with bonds right now. Bonds and fixed income have had a pretty tough time last couple of years, really since 2020. 2020, the yield on the 10-year was what,
Yeah.
0.5%, something like that. Today it's 4.5%. For those that don't know, when the yield increases on a bond, the price decreases. So that's where you're seeing a negative return in bonds. We've had a tightening cycle since 2020 to try and battle inflation. And unfortunately, that means fixed income doesn't do as well. The good news is from this point, if you're getting 10-year 4.5% per year on a bond for 10 years on a US Treasury bond, that's a pretty good return. So there may be more pressure, but if you're a long-term thinker, fixed income's not a terrible place to have some money. So we're happy with 8.6% because of the bond exposure.
And I want to double click into this because when we talk about inflation and whether or not the new Fed chair will bump up rates to rein in spending and try to bring prices down, the flip side is the pressure that puts on the bond markets as well.
Yeah, exactly. And we talked about stagflation last time as well, which is lower growth, higher inflation, higher unemployment. That's about the worst thing that can happen to an economy and the most difficult position a Fed chair can be in. So fixed income and the Fed expectations completely flipped in the last year, right? Last year coming into 2026, we thought we were in for a couple rate cuts. So rate cuts would boost the economy, make your debt a little cheaper,
Yeah.
maybe make your mortgage a bit cheaper if you're on a floating rate. Instead now, because inflation has been so persistent with the higher oil prices we've seen, um, this huge buildup in the technology backlog and memory and chips has driven up prices for
Yeah.
many things across the board. The Fed's kind of stuck in a place where it can't cut rates. Now it has to think about actually hiking rates. And this year, the expectations are for one or even two hikes instead of two cuts. So it's almost a full percent swing
Yeah,
on
and
that
this
one.
is not good news for the home buyers, not good news for people that have debt out there. So we really do need to try to rein in this inflation without it resulting in rate hikes. We really need oil prices to normalize so that and it's a tough position for the Fed because so much of the oil prices are driven by the war.
Yeah. And whether or not that's temporary too, right? Is
You
the
got it.
question.
And so
Yeah.
if they go ahead and they hike rates, but then the war ends, then you sort of prematurely hike the rates. And now the market is in its own tailspin. It's got whiplash over what's going on.
Talking about portfolio returns,
Yeah.
the last 3 years in markets have been extremely strong,
Yeah.
outsized strong. And to get 8% in 6 months in a balanced portfolio, that's a good return. We still have 6 months to go. And yeah, we'd have to temper expectations. Markets don't always go from the lower left to the upper right, as
Yeah.
they say. So
We've got like the balanced one.
the balanced one as well. So more bonds in this portfolio. It's about 55% bonds. It's up 6% this year, six and a quarter, which is, we're really happy with. Bonds on the year are basically flat on the year. So to have the other half of the portfolio still return six is quite good.
Yeah.
And then we have the conservative portfolio to round it out. That's our full fixed income portfolio. I'm comparing that to what the S&P 500 and the NASDAQ. It's not for those types of investors. This is for the people who need their money to not lose money, basically long term. And this portfolio it's up about 4% in the last year. It's up, just under 1% on the year. But given how interest rates have gone this year and fixed income is done, we're happy with that as well.
Yeah. Inflation is running at 3.3. That means we need to find investments that will outpace inflation. Because otherwise
Yeah,
we're losing the buying power of your dollar, and our jobs are to make sure that your investments are growing and that you're retaining and doing better from the buying power of your dollar.
for sure. The markets are never changing, ever growing. place to invest your money. But the good news is if you stick with it 10, 20 years from now, you're not going to be wondering how the markets performed in July 2026. It's going to be a much different world. And generally, over the long term, you make money investing in the proper places if you do it properly and diversified and own good companies.